Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive in, let's take a look, see what people are sharing. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, looking for investment opportunities, sharing all those opportunities with the community. We do have a discount coupon code that is active at this time. Special is the discount coupon code. You get 50% off the first month only on a monthly membership. You get a larger discount on a yearly membership. The value is I do midweek updates on what I'm doing, what the markets look like. And then I also do question and answer sessions and answer your guys' questions and go into a whole bunch of different topics that people want to dive into. It could be the yield curve, uninverting. It could be historical patterns. We've done training sessions that are on the website for technical analysis. Also talk about market conditions, which are cycles too. So we're starting with the yield curve, and I asked artificial intelligence, at least in the search, I asked, how often does the yield curve uninvert while yields go up? And of course, it doesn't really respond to the yields going up, but we can go over the yield curve uninverting. It says, the yield curve is a chart that shows the yields on debt, and it typically uninverts when interest rates on the long-term bonds are higher than those on shorter-term bonds. The yield curve has inverted 28 times since 1900, and a recession has followed in 22 of those cases. However, the relationship between yield curve inversion and a recession is not always clear. The recent recessions, the four most recent recessions occurred after the yield curve had disinverted. The current period of inversion has been the longest sustained since 1976, but the U.S. economy is still expanding. The uninversion and stocks. Uninversion hasn't necessarily spelled doom for markets, and one-year numbers have historically been good. Here are some other things to consider about the yield curve. When a recession follows, typically a recession follows 6 to 12 months after the yield curve inverts. However, the time gap can vary from 6 to 36 months. Yield curve differentials. The 3-month 10-year and the UST 2-year 10-year differentials are two yield curves that market participants closely follow. I follow the 2 and 10. And then the flattening. The yield curve can flatten, meaning the differences between the 3-month and the 30-year maturities are marginal. So that's what AI has given me, at least, AI overview of what it grabbed. Is that useful? Not really. I already understood that there was a high probability of recession after yield curves uninvert, where the 2-year drops back below the 10-year, which is in the situation that we're in right now. But it didn't really go over when did yields go up and the yield curve uninvert. When I looked at history, I didn't really see too many times in history where this has occurred. The late 1970s might be one area where you could say it was occurring, and that's about the only time I could find. During those market conditions, when you go and you dive a little bit deeper, the yield curve inverting and uninverting, obviously it has to deal with inflation or the lack of inflation. But almost all those times in history, 1990, 1970s, and so I should say 75, 1981, whenever else it came back down, early 70s, late 60s, those were all from real estate markets that went into a hyper supply phase, all of them. 2007. So I don't think we're in a hyper supplies phase yet. We've got 3.5 or 3.8 months of existing inventory, which historically has never had a down year in terms of price performance before 2020s. We have seen prices fluctuate here depending on the cities, even with low inventory levels. And there's obviously some cities that have higher inventory levels. So it's kind of a weird mix that we've got going on, where we've got the yield curve uninverting. The housing market in terms of inventories is not horrible. And we've got yields going up. So it's kind of a head scratcher. And I'm trying to see what AI and what historical cases from history have for information and data. And this is what I was talking about. This is the 10-year yield. We went from a downward sloping, downtrend into 1941. 1941, I would say, is the ultimate bottom. We came on up from 1941, and we broke out of the downtrend, went sideways for a little bit, and then we started a big move higher in interest rates on the 10-year. We peaked in 1981, July of 1981, July, August, and we came all the way down. This is a shoulder head shoulder peak. We also have an inverted shoulder head shoulder at the bottom of it in 2020, 2021. And now we're in an uptrend. And that uptrend is something that people should be maybe not worried about, but aware of. Stocks didn't do very well when interest rates were going on up. There were times it did very well, and there were times where it did very poorly. Depending on how fast this moves, it can have an impact on the pricing of assets. And what I'm seeing now is we are moving here recently. This is the 10-year yield breaking out upwards. At some point, wherever that point is, and I think it's getting close, it's going to start impacting the stock market. Stocks are a function of interest rates. It is a derivative of it. So as interest rates continue to go up, people are going to say, you know what, with interest rates up at 5%, if we get up there or higher, we could see a big pullback in interest rate sensitive stocks like growth stocks. That's historically what's played out. And we are at really high valuations given history for those technology stocks. Here's the 10 and 2 yield curve and the unemployment rate underneath it. So whenever we see the yield curve drop, or I should say uninvert, so it goes up in this case, whenever we see it go up and we see unemployment go up, that's generally we get the recessions. So recession back here in the 1990s, we had a recession here in 2000, 2001, we had a recession here in 2007, 8. And then we've got unemployment rate looks like it's turning up. And then we also have the 10 and the 2, that's turned up too. So are we going to have a recession here? To me, if I were just looking at data and I were to just look at history, I'd say, yeah, you're probably going to get a recession here any second. Or you're in it. So I put in a bunch of commodity currencies, and yeah, I understand that the British pound is not a commodity currency. These are the exchange rates against the United States dollar. We've been squeezing into the corner here, and we've maintained or stayed pretty low for the Brazilian real. I have a feeling that we could still strengthen on the dollar until yields were to turn around. So those yields continue to go up, 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 up. That's putting a lot of pressure on all these other currencies. Strong dollar and weaker emerging market currencies. And that's exactly what we're seeing in all of these. We've had a pullback in the Canadian dollar. We've had a pullback Brazilian real. We've had a pullback in the Australian dollar. All of them have been pulling back. And this is the British pound pulling back to the support level. And these are the 3-hump consolidations. Why is this such a big deal? Because commodities are priced in dollars, and when the dollar falls, you're going to get a different you're going to get a rotation of money that flows differently in the markets. That money flow changing is going to move towards emerging markets, towards commodities, towards things where those other currencies are in favor. We are not there yet, but the charts do look good. They don't look bad. Whenever you get these structures, yeah, we could do a false breakdown and then a slingshot higher. We could. What would cause that? A potential recession, and then the Federal Reserve will respond with potentially cutting interest rates, and they may be too late, and maybe they cut, and they spark commodities to take off. And then when commodities take off, priced in dollars, we'll see these currencies potentially strengthen. The last bull market was from 2001 all the way to 2011, and you can see the currency during that time frame. It was driven by the currency, 2001, 2, all the way up to 2011, which is up here. And then the Brazilian real did the same thing. It was the strength of the Brazilian real here. And these currencies, as they move against each other, some companies borrow in dollars but earn in other currencies, their native currency. And that's where you get these exchange rate, like absolute ballistic moves out of some of the companies. And when I mean ballistic moves, from this period here of 2001, 2, all the way up to 2008, some of them went up like 50, 60x, 100x, depending on what you're looking at and what sector you're in. So that's kind of what I'm looking at, and I think that's going to be coming at some point here. Maybe not yet, but I'm watching because I think that's where a lot of opportunities are at. Here's the metals weekly price and performance. So zinc was the top performer this past week, at least on this list. Tin looking pretty good. Aluminum holding on. Uranium getting absolutely blasted. Palladium down slightly. Gold, barely noticeable, 0.5%. That's not really a big deal. Platinum down, basically flat. Silver basically flat too. These are all flat in the middle here. So yeah, not too bad. The Great Martine. Now, this is some really interesting stuff here. This is actually incredibly important. How do the people of the United Kingdom feel about 12 to 15% mortgage rates? The 10-year looks ominous. The longer the sleeper, the bigger the move. Look at this resistance level we've got here. And this thing, if we break to the upside, holy crap. And this is yields. 10-year yields on U.S. government bonds for Great Britain. And that thing looks like it is ready to rip. Absolutely ready to rip. Look at the lows come up here. Low, 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 and it's coming right into this resistance. And usually when you break these long patterns that started in 2022, you can get a big run. So that's something I'm watching here. That's insane. There's another one coming up too. And here's another thing to look at. If you look at this, gold generally does really well. And when yields go up, the 60-40 bond portfolio is going to decline. So what he says here, yes, gold is broken out, and that is good and bullish. But until it breaks out versus the 60-40 portfolio, we ain't seen nothing yet. Well, yeah, that's true. We're going to see a big move in gold, a big move in silver, big move, I think, in oil. Last time we had yields go up, oil was an absolute, it ripped. So I'm looking at all this stuff, and man, this yield breaking out, that could be a big move. Coming down, the IRS has announced many changes for tax year 2025. Here's everything that's changing and how it impacts your paycheck. We'll go over it really quick. The standard deduction, if you're married filing jointly, went up. $30,000 versus $29,200, so up $800. The brackets also changed a little bit. So the 2024, if you were to look, if you're making $94,300 for 22%, it's now $96,950. So all of those brackets are changing and moving higher. In contrast to 2025, if you make the same amount, 100 grand, 24 versus 25, you'll pay less taxes by $227 a year because of the adjustments. Capital gains tax in 24, that if you're looking at married filing jointly, that moved up quite a bit for that. 94,050 for zero capital gains tax, and that moved to 96,700 for capital gains. Earned income tax credit, 24, three or more children, 7830. In tax year 2025, the maximum earned income tax credit is 8,046. Annual retirement contribution limits have been increased. They were 23,000, now they're 23,500 for pre-tax contributions. You can put more than this in your in there, but that is just the pre-tax retirement contribution limits. So this guy's actually, yeah. So in addition, the total annual amount you can contribute in a 401k plans increased to 70,000 from 69. That's your total. Roth IRA income limits. In 2024, the maximum income limit to contribute to a Roth IRA directly is 161,000. My lord. In 2025, the income is increasing to 165. Oh, that's the max income level, and 246 for married filing jointly. The limit on annual contributions to an IRA went from 7,000. It's staying the same. Sorry, it's 7,000 in 24. Unfortunately, the contribution stays the same, unchanged in 25. Annual gifts. The current annual gift exclusion is 18,000 per person. The annual exclusion for gifts increases to 19,000 for tax year 2025. HSA money, that's the health savings account. For 2025, participants who want to contribute to an HSA must have a deductible that is not less than $2,850, a $50 increase from 2024, but not more than $4,300. The child tax credit remains unchanged at $1,700. And that's all we've got for that. So those are the new limits for 2025, if you wanted to know. Here's Dr. Jim Willie. He's saying people are selling their physical silver due to financial struggles. But beware, this is a rigged game designed to scoop up silver at rock bottom prices and sell it back to you at a massive premium. Don't fall for the trap. Physical silver is the ultimate weapon against the corrupt system. Hold on to your silver because the end game is near. The lies of the paper markets are crumbling, and true value will be defined by physical silver. The silver revolution is coming, and it will break the system wide open, in his opinion. And of course, everyone's doubting. We're in the disbelief phase. Markets are crumbling. I've been hearing that since 2000, literally. I don't put any type of time frame on anything. If silver's cheap, I buy it. If platinum's cheap, I buy it. And if I have to hold it for some years, okay, no big deal. It's a part of the game that I'm playing. A part of a strategy. Japan's in serious trouble. Here's another 10-year yield chart. It says stagflation about to worsen. We've got resistance through here. Kind of a shoulder head shoulder deal going on, and it's starting to break out right now. And that's Japan's government bonds. And I'm wondering if we're going to get a big sell-off. Remember last time when we got a spike in yields in November back here? You know what happened? We had that margin, the carry trade kind of blow up. Is that going to happen again here? It could. It very well could. And this looks like we are ready to launch here. I mean, that looks really, really strong to have yields move higher. Art Bourbon says bullish copper demand forecasts are set to crumble, likely dragging prices down. Widespread renewable adoption, including EVs, won't happen without steep declines in growth and living standards. From Goring and Rosenzweig. So, I don't know, guys. I look at the mineral constraints out there and the deficits of some of these metals, and I just go back to thinking, well, we're going to use a lot more oil. But if you look at oil depletion and shale, I don't know how much more growth we have out of it. I really don't. And we're going to get in a tight, sticky little situation here, probably from here to about 5 years out. it's going to happen somewhere in that area. A lot of people say it's going to start this year in 2025 coming up. We'll see what happens. So here's Tracy. She says, and I think this is important to understand. Oil demand stays strong despite EV surge. Despite record-breaking EV sales in China and Norway, oil demand remains strong. In November of 24 alone, the Chinese market once again beat its previous record set in October by over 50,000 vehicles to reach almost 1.3 million EVs sold. EV research house Row Motion said earlier this month, and yet crude oil demand in the biggest of all EV markets in the world is still on the rise. Last year, 82.4% of all new passenger cars sold in Norway were fully electric, up from about 79.3% in 22. According to the Norwegian Public Roads Administration and the Norwegian Road Federation, this share has jumped to over 90% this year, but the impact on Norway's oil demand has been negligible, bank UBS said earlier in the year. The reality of oil demand is that it underpins everything, including EV manufacturing, given the multitude of petroleum derivatives that EVs feature. One could go as far to say there could be no energy transition without the very hydrocarbons that transition advocates want to do away with, and that would be a statement of fact. This is why oil demand growth may moderate in the coming years, but it would be a while yet before it starts declining. So I agree with that. Totally. Here's the platinum to gold ratio, and I know some people are like, "Oh, he's still bullish after 4 years." I am still incredibly bullish on platinum. If gold is a 6x from here, at least, which I think, imagine where platinum would be if this ratio goes back to all-time highs, which I think it will. So platinum versus gold, when price of this ratio of chart moves up, platinum outperforms gold. 23-year bullish falling wedge. Undercut is now done, in his opinion, and we'll see if that plays out that way. Now, am I banking on this going up that amount? I'm not. I'm going to get whatever it's going to give me. And it gives me a diversification out of the system. So if it goes up 563% against gold, which is insanely good, because I think gold's going to at least go sideways or higher. So if gold's at, let's just do a round number, 3,000, that means platinum's going to be, I don't know, 15,000 or something like that. That's insane. Michael Gayed says, to refinance $7 trillion in debt, they must save bonds by crashing stocks. Correct. They must force the flight to safety trade back into that refinancing. I was stupidly early in arguing this a year and a half ago, but I still think this is a likely scenario. When? I don't know. So what they're going to do is they could crash the stock market, creating demand for bonds because they have to refinance $7 trillion in debt. So why don't they create the demand for that debt by crashing the stock market? That is a possible scenario. The only thing that is, I would say, might not occur is they also get tax revenues from stock profits of people. So if they were to do what he is suggesting, if they were to crash the stock market, the government would earn a lot less in tax revenue. Just an FYI. Part-time trader here. It says on the bigger picture, as 2024 draws to close, here's a series of predictions for what next year and beyond could hold for markets. I posted many of these charts before, but keen to step back from LTF and focus on the bigger picture. Let's start with Bitcoin. So in his opinion, he thinks that we are going to come back down in Bitcoin over time, and that would also link up quite well with that 10-year we were looking and yields going up. We could very well get an outcome like this, where the stock market comes on and pulls on back and Bitcoin follows with it. And this here, he's using a ratio chart. Keep in mind, this is Bitcoin divided by Tether. Number two, Bitcoin has hit major resistance and is printing a bearish engulfing 2W candle alongside a huge bearish diverging on the RSI. I believe a global recession and the return of inflation will drive the crypto market lower than anyone can imagine. ETH, which is Ethereum, will get hit even harder. And he thinks Ethereum priced in dollars could go way, way down, maybe even down to where it was in 2020, 2019. He says, in fact, I think the alternative market will get blown apart. Just as confidence in alt season grows, Ethereum Bitcoin has not been able to sustain a move higher for 4 years now. And I believe more pain is ahead. Here it is coming, and this is the underperformance of Bitcoin or of Ethereum versus Bitcoin. Number four, coins like SOL, which is Solana, I think, or something, Solera, face huge declines as Bitcoin suffers its largest drawdown in over a decade. They first posted this chart 6 weeks ago, and so far it's following the path perfectly. What would cause such widespread panic in crypto? Well, quite simply, equity markets are on their last legs. Speculative assets will not thrive in a market where indices finally give in to reality. Here's what I'm expecting for the NASDAQ. He's got a big move lower. Now, I think this is coming. I just don't know when. We're going to roll over. I don't know the exact timing of it. We're at the tail end of a major bubble, which I agree with, that has formed in the era of cheap money and QE since 2008. Just look at Costco chart, and it should tell you everything you need to know. When a business like this is trading at 60 times earnings, it's time to be cautious. Totally agree. Totally agree. It's overvalued. NVIDIA has been a darling of the AI bubble that has formed in recent years and is up over 200x since 2016. A 5K investment would mean you're a millionaire now. It's been a fantastic ride, but be careful not to buy into the hype just before reality bites. Don't believe we're in a bubble? Fine. But the yield curve is also pointing to huge problems. Deepest and longest inversion for a century. Disinversion coincided with major stock market crashes in 90, 2000, and 08. Credit markets are in big trouble. And that is the yield curve coming on up. Banks borrow at short-term rates and lend at long-term rates. When that spread is negative, credit contracts because banks cannot lend profitably. The entire economy is built on credit, so this is a major warning sign. And this is DXY strength is also telling us something is wrong. Agreed. Says he's called the bottom on the DXY back in August when almost everyone was convinced it was heading lower. As investors flock to safety, I expect USD to outperform every other fiat currency. This is USD, JPY, for example. We could see a big move higher in his opinion. And here is GBP, British pound versus USD, and he has it coming back down. As credit markets seize up and equities come tumbling, central banks would normally lower rates and print money. The problem is, long-term rates have broken a 40-year downtrend and look set to go higher. Markets are calling time on the government debt bubble. Here's the big move for 10-year yields. Governments are now spending huge sums on interest payments, and a world built on 0% rates look fragile. In the end, inflating debts away will be the only way to restore a sustainable debt to GDP ratio. This dynamic will drive hard assets like silver much higher, and he's got the big cup and handle that he's tying in to this big picture that he is trying to form and create. He says, oil will also be a major winner in this context, outperforming equities in a 1970s-esque bull market, driven by inflationary pressures and global instability. Well, here's my opinion here. They need to print money to keep the system alive. For the system to survive, they need to print. we are going to run into oil constraints. Those oil constraints are going to drive oil ridiculously higher. That oil price going higher is going to drive interest rates up. And that's why we've got these big GBP and all those yields are set to break higher. This is also why I think we can tie in the silver cup and handle that's going to go to the moon. It's because the system won't be able to survive unless oil production can increase at roughly the same pace that they continue to print money at. That's the dynamic we've got going on. So there you have it. That's my view on the next couple of years. Remember, these are bigger picture charts. I'm not concerned about what happens over the next month or so. I'm trying to spot major shifts that could accelerate in 2025. Let's see how this all plays out. I completely agree with his opinions. And of course, everyone's going to put these comments in disbelief for all of that. But I agree with most of it. I do. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We've got that special discount coupon code special if you like to use it. And that's all I've got for today. So we'll catch you next time. This is Finding Value.